Hi candidates, welcome to another session of manifested online classes. So we are still soldiering on with the topic of group accounts and in this session I want us to look on how we prepare the group accounts, specifically whereby the parent company has invested in a subsidiary, and basically the preparation of the same is governed by IFRS 10. So mean that IFRS 10 lays down the procedures to be followed by the parent company in preparing the group account, specifically whereby the parent company has invested in what? In a subsidiary. So you have to recall that a subsidiary is basically a company which is controlled by the parent, meaning that the parent company has acquired shares which are more than 50% of the shares issued by the subsidiary. Actually, we have said that anytime a company acquires shares which lies between 51% to 100% of the shares issued by another entity, then the investor company is known as the parent, whereas now the investee company is known as what? The what is known as the subsidiary. So mean that the parent company here, which has invested in a subsidiary company, we say that this company has an obligation to prepare the group accounts. And when these group accounts are being prepared by the parent company, then they must be prepared in accordance with what? IFRS 10. So we are saying IFRS 10 lays down the principles, the procedures to be followed by the parent company in preparing now the group account. And the important point here in identifying a subsidiary is basically the control. Generally, we have said that the parent company exercises control, basically do have a control over the subsidiary, whereby the parent company holds shares or has acquired shares which lies between 51% to 100% of the shares issued by what? Issued by the subsidiary. So therefore, the parent company at the end of the year is the one which is required to prepare the group accounts, or to prepare the consolidated financial statements. And according to IFRS 10, this group account should be prepared by the parent company by combining, or in other terms, by adding together similar items of assets, liabilities, revenue and expenses of the two entities here, the parent and also what? The subsidiary, as if now these two entities are a single what? Entity. So therefore we can say that the parent entity, or basically the parent company should prepare a group account by combining or adding together similar items of assets, liabilities, revenue and expenses, similar items of asset, revenue, that is liabilities, revenue and expenses, those of parent company and the subsidiary. So in very simple terms, what this means is that in preparation of the group accounts, the parent company here and the subsidiary are actually treated as a single entity. They are treated as a single company, and that's why we are saying that their similar items of asset, liabilities, revenue and expenses should be combined, or in other terms, they should be added what? They should be added together. So I want us to look on the procedures to be followed by the parent company in preparing those particular group accounts. And first of all, I want us to look on how to prepare the consolidated statement of financial position. And we start by looking on the consolidation procedures. Consolidation procedures. So the consolidation procedures, these are the steps to be followed by the parent company in preparing the consolidated statement of financial position. Number one is that the group structure, or basically the parent company should come up with a group structure, meaning that anytime you come across a question, you are told the parent company has invested in a subsidiary, you are required to prepare a consolidated statement of financial position. The first thing you need to do is to come up with a group a structure. So what is a group structure? A group structure basically is a form of a chart which will be showing the parent company shareholding in the subsidiary. For example, in this case, let's assume that the parent company acquired 80% of the ordinary shares issued by the subsidiary. And also in your group structure, you must have the date of acquisition there, the date the parent company acquired the subsidiary. That is the first thing. Come up with a group structure. The number two is that you need then to consider the consolidation adjustments. Consolidation adjustments. So these are the adjustment to be made in preparing the group account. So after adding together similar items of asset, liabilities, revenue, and expenses, those of the parent and those of the subsidiary, there are some important consolidation adjustments to be made. And actually that is what we are going to discuss next. Some of these consolidation adjustments include adjustment in relation to something called intercompany debt. Intercompany debt. We also have adjustment relating to an realized profit on inventory. And realized profit on inventory. We also have adjustment relating to what you refer as a fair value adjustment. Fair value adjustment, also known as a fair value exercise. We also have adjustment relating to intra-group sale of assets, and then we have adjustment relating to something called the goods in transit. The goods in transit, GIT. So this is basically what you're going to discuss next. So once you have determined the consolidation adjustments you need to make, then from there, step number 3, you need to combine. You need to combine. So basically by combining, that means what? That you add together similar items of asset and liabilities. Remember here we are looking on the consolidation procedures for preparing the consolidated statement of financial position. We know in a statement of financial position, what is recorded here are assets, liabilities, and what? Equity or capital. So in this case, we are saying what we combine or what we add together are only items of asset and liabilities. Basically, we don't combine items of what? Of equity. So therefore, in this case, we combine, or in other terms, add together similar items of assets and liabilities, those of the parent and those of the subsidiaries, and eliminate any intragroup balances. Eliminate any intragroup balances. Eliminate any intragroup balances. So when we talk about intragroup balances, we are talking of something like amount of intercompany debt. Maybe the parent company or the subsidiary a certain amount of money. That is a good example of intercompany debt. That should be eliminated. And actually, we're going to look on how we eliminate the same. And then from there, step 4 is that for share capital, include that of the parent company only. Include that of a parent company only. Include that of parent company only. So for share capital, we don't combine the share capital of the parent and that of the subsidiary. We only include that of the parent company only. Very, very important. So then number 5 is that you compute something called the group retained earnings, and something called the non-controlling interest, group retained earnings, and the non-controlling interest. So before you look on an illustration regarding the preparation of this, maybe I can just explain something on these two items, how to compute the group retained earnings and what is NCI. Maybe let me start with the non-controlling interest. Non-controlling interest, abbreviated as NCI, non-controlling interest at year end. At year end. So remember, there is something we have mentioned here that when preparing the group account, or basically when preparing the consolidated statement of financial position, then we are saying that we do what? We add together similar items of asset and liabilities, those of the parent and those of the subsidiary. Like maybe assuming here, the parent company acquired 80% of the shares in the subsidiary. So how do you prepare a consolidated statement of financial position? So what you do, you take 100% of the asset and liabilities of the parent, and to that you add 100% of the asset and liabilities of the subsidiary. But in this case, you can see that the parent company only acquired 80% of this subsidiary. Or in other terms, we say that the parent company only acquired 80% of the asset and liabilities of this particular what? Subsidiary. But in preparing the consolidated statement of financial position, we are saying we take into account 100% of the asset and liabilities of this particular what? A subsidiary. So this particular standard here, IFRS 10, requires that the parent company should compute or basically should be able to compute the net asset which are owned by the minority shareholders, because in this subsidiary we have minority shareholders who own 20% of this company. So, and once the parent company compute the net asset in the subsidiary owned by the minority shareholders, and which now will be known as the NCI, that should be included as a separate item in the consolidated statement of financial position under the equity section. Under the equity what? Section. Now, how do we compute this particular non-controlling interest at the end of the year? But even before you look on the computation of the same, we can say that this is the NCI share of net asset in the subsidiary company. In the subsidiary company, this is the NCI share of the net asset in the subsidiary company. So we can say it is computed as follows. It is computed as follows. So what we do, number one, we take the NCI share of subsidiary company net assets. At the end of the year. And then to this, in case we compute the goodwill using the full goodwill method, we come and we add what we refer as a NCI goodwill. And then to this we less the NCI share of impairment loss. Share of impairment loss. So whatever you get here is the NCI share of the net asset in the subsidiary company, and what you are saying is that this one should be taken to the consolidated statement of financial position as one of the equity component, or actually should be recorded in the consolidated statement of financial position as an equity component. Component. So basically that's how we compute the non-controlling interest at the end of the year. There is another item here which is called now the group retained earnings. The group retained earnings, group retained earnings. So the group retained earnings, in other terms, this is like the parent or the group retained profit at the end of the year. So how do we compute this? So to compute this, we take 100% of the parent company retained earnings plus the group share of subsidiary company post acquisition retained earnings. So when talk about the post acquisition retained earnings of the subsidiary, so this is the retained earnings of the subsidiary company after it was acquired by the parent. After it was acquired by what? By the parent. And in that case, you will not include the full amount, but you only include the group share. So when talk about the group share, for example, in this case, what you do, you determine the retained earnings of this company after it was acquired by the parent company, and then to get the group share of this, you have to multiply that with 80%, and then to that you add 100% of the parent company retained what? Earnings. And actually, whatever you get here is the group retained earning, and still that one is also recognized in the consolidated statement of financial position equally as a component of what? Of equity. So therefore, these are basically now the procedures to be followed by the parent company, specifically in preparing the consolidated statement of financial position. So I want us to look on an illustration regarding how we prepare this, but an illustration without any of this particular what? Adjustment. We're going to look on this particular adjustment later on. We discuss on them in details, and equally we look on some illustrations regarding how to deal with them. So we have an illustration here, and it reads B Limited acquired a 60% investment in H on 1st January 2020 for shillings 720,000, when the retained earnings of H Limited were shillings 300,000. The statement of financial position of the two entities for the year which ended 31st of December 2023 are presented below. So we are given the statement of financial position of B Limited and also for H Limited. We have the non-current asset, which include the property, plant and equipment, and then we have the investment in the subsidiary. We have the current asset. We have equity, which comprises of share capital, retained earnings, and then we have non-current liabilities and then current liabilities. And then we have some additional information. We are told an impairment review was conducted on at 31st December 2023, and it was decided that the goodwill on acquisition of H Limited was 10% impaired. And then number 2, we are told it is the group policy to value non-controlling interest at fair value at the date of acquisition. So this is something we discussed in our second session, and basically what we said is that if you come across that particular information, that it is a group policy to value, or in other terms to measure NCI at fair or full value, then it means that when computing the goodwill on acquisition, you compute that goodwill using the full goodwill what method, full goodwill method. And then you're told the fair value of non-controlling interest as at 1st of January 2020, that is now the date of acquisition, was 480,000. So what are we required to do? We're required to prepare the consolidated statement of financial position of B Group as at 31st of December 2023. So basically these are a question for group account, and remember what you have said is that once you come across such a question for group accounts, so what do you do? Which procedures do you follow? Which steps are you supposed to follow? Number 1, come up with a group structure, and then number 2, you need to consider the consolidation adjustment. So in this question, we don't have any adjustment other than the computation of goodwill on acquisition, because you have said that is a requirement under IFRS 3 that anytime the parent company acquires a subsidiary, the parent company has to determine the goodwill on acquisition. So we are going to determine the goodwill on acquisition using now the full goodwill method, and then from there we do what? We are going to proceed and we combine similar items of asset and liabilities, those of the parent and those of the subsidiary. And then for share capital, we have said we only take into account the share capital of the parent. And then later on, we are going to do what? We are going to compute these two items. We are going to compute now the group retained earnings and the NCI. So these are the procedures we need to follow. So therefore, the first thing we need to do here is we automatically come up with a group structure. That's the first thing we need to do here. So the first thing we need to do is to have the group structure. So where do we have information about the group structure? We have that information in paragraph 1 of the question, where we are told B Limited acquired 60% investment, 60% investment in the company which is called H Limited. H Limited on 1st of January 2020. So meaning that B Limited, this will be our parent company. This will be the parent company, whereas these are our subsidiary. These are subsidiary. And also from this particular information, we can say in this particular subsidiary, the minority shareholders have an interest equal to 40%. The percentage NCI is 40%. So we are told the amount of purchase consideration which was paid was 720. That one will be used in the computation of goodwill. And then we are told that the retained earnings of H on the date of acquisition was what? Was 300,000. And then we have some other information there. I think before we proceed and combine similar items of asset and liabilities, because the first thing we have done, we have come up with a group structure. This is a group structure. And the reason why it is important for as a candidate to come up with a group structure is for you to know which is the parent company, which is a subsidiary. So like in our case, we know B Limited is a parent. This is a company which is required to prepare the group accounts by combining similar items of assets and liabilities of the two companies. So this company has the obligation to prepare the group account by adding similar items of asset and liabilities, those of the parent and those of the subsidiary. Also, we have said on the date of acquisition, the parent company has to determine the goodwill on acquisition. So therefore, I think step 2, before we proceed to combine, to add similar items of asset and liabilities, I think we can compute now the goodwill on acquisition. So let's compute the goodwill on acquisition. Goodwill on acquisition. And as per the information which are given in the addition information number 2, we are using the full goodwill method. The full goodwill what? Method. Full goodwill method. So let's compute that goodwill here. So we need to have 2 columns, and our figures are given in thousands of shillings. So to compute the goodwill using the full goodwill method, number 1, we take into account purchase consideration. Purchase consideration paid by parent company. That is the first thing we should have. That is given is in paragraph 1, that the parent company paid an amount of 720. And actually this is a cash consideration, because if you go to the statement of financial position of B, specifically at the non-current assets, you can see something called investment in subsidiary, which is 720. This is a cash consideration. And then to this, we add something called the NCI at fair value. The NCI at fair value, this one is given in addition information number 2, the last sentence, which is given as a figure of 480. So we add these 2 values here, which will give us 0, 0, 11, 12, 11, 12. So to this then, what we need to do, we need to proceed and we less the net asset acquired by both the parent and also what? The NCI. This amount which we have here, we need to proceed and we less the fair value of the net asset acquired by the parent and also NCI. But mostly what we said is that that is a figure which the examiner will not give you, and therefore you have to recall how we compute the subsidiary company net asset at the date of acquisition. And actually we said we compute that by adding the ordinary share capital of the subsidiary plus now the reserves of that subsidiary on the date of acquisition. So therefore to this what we need to do, we need to less fair value of net asset acquired less fair value of net asset acquired. Net asset acquired. And because you're not given this one, we have to compute it. How do we compute this? We compute this by taking the subsidiary company ordinary share capital. The ordinary share capital of the subsidiary from its statement of financial position is 500. And then to this we add pre-acquisition reserves. Pre-acquisition reserves, these are the reserves which the subsidiary company had at the date of acquisition. The reserves include share premium. If you go back to the statement of financial position of the subsidiary, you'll be able to see that that company do not have any share premium. If we had any share premium, also include it there. And the only reserve which is there is the retained earnings. But in that case, we take the retained earnings of the subsidiary on the date of acquisition. On the date of acquisition, and this one is given as part of the or is given in paragraph 1. If you go back to paragraph 1 of that particular question, you are told the retained earnings of H Limited on the date of acquisition was 300,000. So this is now the pre-acquisition retained earnings. So this company do not have any other pre-acquisition reserve. So we get the total here, which is 800. And because we are using the full goodwill method, we're interested with the net asset acquired by the parent and the NCI. So therefore what we do, we take 100% of this. 100% of that will be 800, and we less that from the figure which we have here. We less that from the figure of 1200, and we get now a goodwill here of 400. And remember, this is a full goodwill. Why do we refer to it as a full goodwill? Is because it is a goodwill attributable to the parent and the goodwill attributable to NCI. Then we are also told in the additional information number 1 that an impairment review was conducted at the end of the year, and it was decided that this particular goodwill was impaired by 10%. So being impaired means that the value of the goodwill here had reduced by 10%, so which now is known as an impairment loss. So 10% of this, which will be 40, and the unimpaired goodwill therefore is 360. So this one is what will be recognized in the consolidated statement of financial position as a non-current asset. As a non-current asset. And I think now with that we can proceed and prepare what we are required to prepare. We are required to prepare the consolidated statement of financial position of B group. So this will be known as P group. That is B group. Group, remember, is the parent company and the subsidiary. So the B Limited and H Limited is a group. So B group, a consolidated statement of financial position as at 31st of December 2023. 31st of December 2023. 31st of December 2023. So we just need to have a single column here, and our figures are in thousands of shillings. So what we start with are the non-current assets, and you have to remember the basic rule here. When preparing the consolidated statement of financial position, then we have said that what we do is that we add similar items of asset and liabilities of the two companies within the group. So under the non-current asset, we have the property, plant, and equipment. So we take the property, plant, and equipment of the parent, 2,300, plus that of the subsidiary, which is 1,900. 1900. And then below that we have investment in the subsidiary. So the investment in the subsidiary is the purchase consideration paid by the parent company in acquiring the shares of what? The subsidiary. That amount we don't include it here because we have used that in computing the goodwill. Instead, what we include here is the goodwill arising from the acquisition. So that goodwill is an amount of how much? Is an amount of 360. That is now what we include here. We don't include that investment in the subsidiary. What about the PP? PP here will give us what? We need to add those two figures. We have 2300 plus 19, which will give us 4200. Do we have any other item of an non-current asset? No. So we add the two figures here, and they'll give us a total of 4560. And then below this we have the current assets. So for current asset, equally we take those of the parent, which is 3340, plus those of the subsidiary, 1790. So we add the two, we have 3340 plus 1790, which will give us 5130. 5130, and then we get the total assets. So the total assets plus 4560, which will give us 9690. Then from there we proceed and record items of equity. We proceed and record items of equity here. So for equity, we start with the share capital. So for the share capital, you have to record here, we don't combine items of equity. Actually, for share capital, we only include the share capital of the parent company only. We only include the share capital of the parent company only. The reason why we don't combine the share capital of the parent and that of the subsidiary is because the share capital of the subsidiary company has been used in the computation of goodwill. Anything which has been used in the computation of goodwill, we don't include it here, including the share capital of the subsidiary. That's why we are saying for share capital, or include that of the parent company only, which is 1,000. Then from there, we have the retained earnings. So for the retained earnings, this one has to be computed. We don't combine that of the parent and that of the subsidiary, but this one is quite simple. So what we do here to compute the retained earnings to be included here, which is now the group retained earnings. Remember, I've given you the formula for computing this. Whereby we said we take what? 100% of the parent company retained earnings, plus in this case we are going to take 60% of post-acquisition retained earnings of what? Of the subsidiary, plus 60% of post-acquisition retained earnings of our subsidiary, which is H Limited. That is how we compute the group retained earnings. So therefore, what we do, we need to have two columns here, for the parent and for the subsidiary. Our parent is B Limited. Our subsidiary is what? Is H. This is basically the format you should use. So first of all, have the retained earnings of these two companies at the end of the year. And where do you get this? You get this from the statement of financial position, specifically under equity. We are given the retained earnings of the two companies at the end of the year. For this one is 3430. For the subsidiary is given as 18. But now you have to remember what we consider as far as the subsidiary company is concerned. For subsidiary, we are only interested with post-acquisition. These are the retained earnings of the subsidiary company after it was acquired, after it was acquired. So therefore, for you to get that, what you do, you come here and you less the pre-acquisition retained earnings. So this is the retained earnings the subsidiary company was having before it was acquired, or basically as at the date it was acquired. And basically that is a figure which we use here in computing the goodwill. So these retained earnings of the subsidiary at the date of acquisition is what we refer as a pre-acquisition retained earnings. We rest it there, such that what we shall be left with here is the retained earnings of B Limited after it was acquired by who? By the parent. Yes, that's what we have. And then there is something also which we come and adjust here, and that is the impairment loss. The impairment loss. So remember this particular goodwill which you have computed here, we are told it was 10% impaired. So what we do, we compute the impairment loss which is to be allocated to the parent company goodwill. The impairment loss to be allocated to the parent company goodwill will be equal to the full amount of impairment loss times the parent company shareholding in what? In the subsidiary. The parent company shareholding in the subsidiary, which is 60%. So this will give us 24. So that one, we less it from the parent company retained earnings. And then you have now to recall that the remaining impairment loss, which will be 40% of this, is an impairment loss to be allocated to the NCI what? Goodwill. Basically, I'll show you where we are going to take into account that particular amount. So we have 1500 here. And what do we have here? We have 3430 minus 24, which will give us 3406. And then finally we do what? We take the group share of this. So the group share of this will be 100%. The group share of this will be 60%. So with 100% of that is 3406, 60% of 1500 is 900. And then what we need to do, we add these two figures plus 3406, which will give us 4306. So this is the amount now which we come and include here as the group what? Retained earnings. The group retained earnings. Actually, you can refer to that as working 3. Because goodwill was in working 2 here. Yes. So this will be, this is from working 3. Yes. So we add these two figures, which will give us 5306. There is something else we also need to compute here, known as non-controlling interest. So the non-controlling interest, basically we have said that this refers to the minority shareholders' share of the net asset in the subsidiary, because in preparing this particular consolidated statement of financial position, you can see we are taking 100% of the asset and liabilities of this subsidiary. But in our case, we know that the parent company only owns 60% of those what? Asset and liability. So what we have said is that in preparing the consolidated statement of financial position, we have to compute the net asset in the subsidiary company, which are owned by the minority shareholders, and then we include that here in the consolidated statement of financial position as one of the component of equity. One of the component of what? Equity. And actually, we have also looked on how we compute what? We compute this. So therefore, let's compute that non-controlling interest. I think I can do away with this working for group retained earnings. We compute the NCI at the year end. NCI at year end. So we compute the NCI. Remember, you're saying NCI is what? Is the minority shareholders' share of the net asset in the subsidiary. Our subsidiary is what? Is H Limited. So what we do, we take the net assets of this subsidiary at the end of the year. So the net asset, this is the difference between assets and liabilities. You can take asset minus liabilities, or you can just take equity. Either of the approach will give you the net asset. But in group accounting, we compute or we take the net asset to be equal to equity, share capital, and reserves. So what is the share capital and reserve? What is the total share capital and reserves of H at the end of the year? It is an amount of 2,300. An amount of 2,300. So what we are interested with is the NCI share of this. NCI share of this. NCI what? Share. So of which now the NCI share of this will be equal to 40%. Will be equal to 40%. 40%. So what will be 40% of this? Let's compute 40% of that times 2,300, which will give us 920. Then to this there is something else we need to come here and we add. There is something we need to add here. That is the NCI goodwill. NCI goodwill, and also we less the impairment loss allocated to the NCI goodwill. So, and I think first of all you can compute this. So the impairment loss to be allocated to the NCI goodwill will be the full amount of impairment loss, this one, and then the NCI share of this will be 40%. 40% of that. So 40% of 40 will give us 16. So that one is to be deducted here. What about the NCI goodwill? NCI goodwill is computed by taking the NCI at fair value. NCI at fair value, hope you can remember that, 480 minus the NCI share of these net assets. NCI share of this net asset, we take 800 times the percentage NCI. Percentage NCI is 40%, so which will give us 320. 320. So we have 480 minus 320 minus, yes, which will give us 160. So this is how we compute the NCI at the end of what? Of the year. So we have 920 plus 160 minus 16, which will give us 10,640. 10,640. So 10,640 is the NCI share of the net assets in that particular subsidiary. And actually we have said that should be included in the consolidated statement of financial position as a component of equity. As a component of what? Equity. Actually, in any question for group account, these are two items which are a little bit tricky to majority of the students when dealing with these particular questions coming from the topic of what? Group account. How to compute the group retained earnings, and I hope you have understood how we have computed the same, and also how to compute the non-controlling interest. So actually we can refer to that as working for. So once you have computed that, finally what we need to do is to record non-current liabilities. Non-current liabilities. So for the non-current liabilities, this one we just add. We just add the non-current liabilities of the parent and those of the subsidiary. This is 350 plus 290. 350 plus 290 plus 290, is that correct? Yes. That will give us a total of 640. A total of 640. And finally, we have the current liabilities. The current liabilities. Also for current liabilities, we add those of the parent, 1580, plus those of the subsidiary, that is 1100. That is 1100. That is 1580 plus 1100. So which will give us 2680. Yes, and then from there, what do we need to do here? We need to get the total equity and liabilities, total equity and liabilities. So we already have our total equity there, which is 5306, this one, plus this, plus 1064, plus 640, plus 2680, which will give us 9690. That should be the same with the total assets. Yes, is actually the same. That will be the same with the total what? The total asset. So therefore, that basically what was required as far as that illustration is concerned. But you can see that illustration actually do not have adjustment, do not have a consolidation adjustment. I think only one consolidation adjustment which was captured there, the issue to do with the goodwill. But in an exam situation, once you come across a question for group account, basically that question would be having a number of what? Adjustment. Therefore, once we come back in our next session, we are going to look on some of the consolidation adjustment which are supposed to be made during the preparation of the group what? The group account. I think we have looked on some of those particular consolidation adjustments which we are going to discuss in our next session. So therefore, we need to stop at that particular point. See you in the next session.